We're good?
Yep.
All right. Well, hey, thanks for joining us in person and thanks for joining us on the web. I'm Travis, this is Tyler, and this is Mortgages 101. And so basically the goal of this class is just a really high level overview of kind of what we do. We're not trying to make junior loan officers at the end of this presentation, but just want to give you some knowledge and some takeaways so that when you talk to your clients, you feel more comfortable when they may have lending questions kind of thing. So just real quickly, what we'll cover is just kind of your role as an agent, a couple categories there, dive into the math of how we actually get people approved and looking, how we align them with their goals. And then just a brief overview of introduction to loans, a bunch of different mortgage products out there. We're going to try to condense it for you. So first, we always like to start as your role as the agent. Like this is a partnership, right? It takes both of us to help these clients get into homes. But kind of like human nature and naturally, at least in my experience, clients tend to start with the agent, right? They get excited, like I want to buy a home. And the first thing they do is maybe go on Zillow or online and start thinking about like looking at houses. When, we may be biased in saying this, we kind of think they should start with getting approved for how much money they may be able to afford. But the reality is they start with the home searching process. So you're kind of like, the first point of contact when we're dealing with clients. So, always ask questions, assess their needs. But we're going to lean on y'all to help us like control this whole process. Help us with the timeline, what they should expect. We try to when someone gets a mortgage, we try to make it as easy as possible, but they do have to put a little work in to get hundreds of thousands of dollars to buy the home. Ultimately, we would love to earn your business as a referral. But typically, when they come to you, they don't have a lender of choice. So we would love to be able to, team up with you and help your clients. And then, yeah, we'll go forward to the next one. Just some common questions to ask. Like I mentioned, have you spoken to a lender yet? For y'all, you're definitely going to want to make sure that they have spoken to a lender, because you don't want to start showing them houses and wait and putting your time into it when they're not able to buy a home right now.
Can I jump in on that?
Absolutely.
Because we kind of want to change that a little bit. So the problem we're having, and that used to be hardcore, that was the way. But in this on-demand, I want it now society, a lot of buyers see something online and their goal is to go see it right away.
Sure.
So if it's a realtor.com lead, they're coming in, they want to see that house. If it's a gold lead, they may be inquiring about a specific house. They want to go see that house. So I wouldn't, if they're asking to see a home, I would go show them the home, but make sure they don't have an agent. No, we're not committed to an agent. Go show them that home and then go into the buyer consultation and deep dive on the lender side. But if you take the stance of, I need you to talk to my lender first before I'm taking you out, they're going to go find another agent to take them out.
Yeah, I guess let me clarify, like, y'all do whatever you want to do, clients, right? Like, they're your clients. Like, it's our suggestion you get them going for the pre-approval process. If you want to do that before or after you start showing homes, no worry. But if you ever have a situation where someone, like Harlan said, just reach out, hey, I love this home, I want to go see it, whatnot, and you need us to act quickly, just give us a text. Like, we're around on the weekends, we don't work 8 to 5. Like, we will help y'all out whenever we can, kind of thing.
And I'm going to show more than 1 or 2 homes and then for sure get them with the lender. But like that first home, usually sometimes I want to see it.
Assuming you get to have a consultation before you go look at homes, one of the questions that, I think that's easy for y'all to ask is talking about earnest option money and inspection costs. A lot of clients don't realize like that's upfront money they need to put forward there. So if someone says, well, no, I don't have any of those things, well, that's maybe a different conversation we need to have to see how we can, work together to get those. I'm going to skip this one and go like, this is my favorite question, at least what when I'm asking, working with clients, it's not so much like how much can you get approved for? I really want to know what monthly payment they're looking for, right? If they tell me like they're searching at $400,000 homes, but they want a $1,500 payment, it doesn't really line up. So we always focus on what kind of monthly payment makes them feel comfortable, and then try to translate that into a purchase price. And then, time frame of when you're wanting to purchase. You may get that client, like Carlin said, I want to go look, on Friday, let's go. Or you may have someone that says, hey, my lease is expiring next summer, kind of thing. So just nice to know what their goals are.
Can I ask a question?
Yeah, and before, thank you. Before we even go forward, stop us anytime you have questions. Like, we feel like this class is way more like beneficial for y'all when you have questions, whether it's real life examples or just generic ones. So yes, absolutely, we welcome.
Like, on a lease, typically they say you can just wait 30 days before you can't get a lease, like 3 months before you're moving, because stuff won't be on the market anymore, is what I have so far been told. So how fast does that money part change? Like, if they've gotten approved, but the interest rates just.
Make sure I answer your question. So we
I
get,
might not have asked it right.
yeah, I guess so. We get all the time, or when we speak to clients, like, we definitely like inform them, because a lot of times we're working with first time home buyers and they're in an apartment lease kind of situation. So, if someone's lease is up in January, I always give the example of, well, hey, it's about a 30-day process, from the time you actually find the home you want, right? But so let's say we start looking in November, lease is up in January, we start looking in November, you find it, the middle of November, you're not going to close until December, but your first payment doesn't start until February. Always get to skip a month after we close, kind of thing. So I always bring that example up to our buyers because it can be a nervous, like, nightmare when you're trying to time out leaving your apartment on Monday and maybe moving into your new house on Tuesday, kind of thing. Like, giving them a little bit of breathing room, like, always makes it like a little bit easier. And you all know, like, just like in life, anything can happen in real estate. What happens if we get a bad appraisal? We got to start over again. So I like that 60-day time frame to try to time up with the lease, kind of thing. But did that kind of address what you were?
Exactly.
Okay, cool. Yeah, it's that skip a payment that's always like pretty helpful that people don't know, because we don't want them to get double dipped on rent and their new mortgage payment if we can avoid that.
Just days, and we're not wasting either their time or yours.
Yeah, and the typical answer is it takes 30 days to get a loan closed. Like, we can get them closed a little sooner, especially if it's a pretty straightforward loan, or if it's someone that we know that's serious about buying. We may do what's called like a true pre-approval, where we take them through the underwriting process and like knock out as much as we can beforehand. So then when we are under contract, we can, fly through it. So we do those for like pretty much like real complicated situations, stuff that we want to get looked at before we like go under contract. Cool. You want to jump over?
Sure. As far as mortgages, like I said, they require work. It does take a little bit of investment from your borrower. If you've got a borrower that hey, they want to give a little, just incremental information. Hey, we want to see it all. We don't Travis and I have a good track record with a lot of agents here, just because we do a little extra due diligence up front to make sure that hey, if we say hey, you're good to go, that's going to happen. So they've got to be responsive to us, get us the documentation that we need. Couple things to kind of jokingly say, but it's not a joke, but always when you're talking with your clients, obviously sometimes y'all see them on maybe extra inspections. You're in front of them maybe more often than we are sometimes. Kind of remind them not to purchase anything on credit. If you have a home that there's no appliances, no refrigerator, and they're like, oh my God, I can't wait to go to Home Depot and get that 12 months no interest financing and go get this thing. Well, there's credit monitoring things where they have to do a little soft pull check on your credit right before you close. Sometimes a random person inquiring or trying to apply for a new debt can slow us up, possibly impact the deal. Do not make cash deposits. Someone like you mentioned about earnest money and option money. If it's like, oh hey, well maybe I'll just I'll go get a cashier's a money order or something along those lines. Anything that doesn't seem like a normal check is going to be delivered to the title company. Maybe, give us a little extra hint. It's always easier to strategize before money gets transferred and deposited, because we can't source cash unless they literally have a bill of sale.
And I'll say we see that a lot, like grandma's giving the grandson cash for his down payment or earnest money or whatever, and now the son's going to deposit it. Like, have them all talk, like immediately, you sense cash is happening, tell them to stop and talk to the lender. because they do have to document it all.
When we have to use cash, like if we truly have to, I mean, we work with clients, it happens so often, like they just don't trust banks. They take their check to the bank, they cash it, get paper money, take that paper money home. So when we talk about deposits, we're like, oh yeah, I've got $20,000 in my safe at home, kind of thing. So like, they're gonna have to deposit that in their account, and then we're gonna need to wait 60 days. And then that's the way we use cash, kind of thing.
So how does that work?
So we only have to look at the last 2 months of bank statements, right? So say if they deposited it today in the middle of September, and then we request like, October and November bank statements, then that's not gonna show that cash deposit. It was like already in their account, kind of thing. So that's why we say like it takes about 60 days for us to be able to use cash.
And on that same note, as far as like, for y'all not wasting your own time showing people properties, if all of a sudden we figure that out, hey, oh, well, we love this home. Well, it's like, if we know you cannot close for a little over 60 days, deposit the money, take a breath. So we don't know, I don't know, more houses may come on the market, so it may go, but don't be showing them houses every weekend. If we know we cannot close any faster than that 60 days, so.
Yeah, and I just want to give one more, like, I really like real life examples kind of thing. And we've been seeing this a lot lately. Treat this as like you are a financial professional, like we both are. You're the agent, we're the mortgage loan officers. So it's okay to, ask questions because we're trying to help them get to their goal. But this whole not purchasing anything on credit, man, what we're seeing a lot of now is people getting these like outrageous car loan payments, like a couple months before they come see us, right? And so then we've got to add a new Tesla payment or a new Porsche. Yeah. Real life example. When we're working with got a Porsche 2 months ago that blew up his debt ratio, which we'll talk about later. But so if you're having a consultation with a client and for some reason, like, it comes out like, well, I'm going to need a new car soon. What's more important, a new car soon or buying a house kind of thing? I'll tell you this, car loans are approved on a whole other spectrum than mortgage loans. In my opinion, basically, you just need to have a pulse to get approved for a car loan. So focus on the house, get the car loan later, or at least talk to someone before you go and make that decision. Like when I say someone, a loan officer, make sure that those numbers are going to work. But we're just seeing it all the time, these crazy car payments that are,
And it's going to happen a lot more at the end of the year. The fourth quarter is the worst for cars because buyers, the salespeople are out there trying to get year-end sales done, and buyers think they should buy, but like tell them to close on the home and then drive immediately to the car lot after that, but get it closed and funded first.
Yeah, and one more real life. Oh, so go ahead. Yeah, same thing. Yeah, actually a little tougher.
Now, I have a question. If I were to say it were different, if I were to tell them, oh, a lease would not impact it the same, if that were true, would that technically be giving advice?
I mean,
Yes.
okay, there you go. So,
Yeah.
Yeah,
So
I
the
mean,
rule of thumb is, hey, I think blah, 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 but you really need to talk to the professional.
yeah, an easy way to sum it up.
Yep.
Yeah. An easy way to sum it up is like, we want to keep their life as like boring as possible while we're trying to get them approved. No major changes, no major anything. Let's just keep what we're doing. And like just a real life example on this job thing. One of the agents here a couple months ago, we were helping a teacher out and we got down to the very end. I'm talking the week before closing, and we have to call to verify that they still work there, right? Just, hey, is Mrs. Jones still a teacher there? Oh, no, Mrs. Jones put in her notice that she's not going to be renewing next year as a teacher. Called up Mrs. Jones and said, hey, what's going on? They said you quit. She says, well, yeah, I'm going to be employed at least until, the house closes, but I'm not planning on teaching next semester. That doesn't work, Miss Jones. So Miss Jones had to get rehired real quickly so we could get closed. Then they become homeowners, and whatever Mrs. Jones wants to do, that's not our business. But just a real life example of what happens. Like, she didn't think she was quitting her job because she was going to be working when it closed, but because she was a teacher and said she wasn't renewing, came back and got us.
And they will do a verification of income or employment at the beginning. And some buyers think, oh, it's already been done. My HR signed off on it, so I'll quit before closing, and they'll check again. Don't you check employment again right before closing?
Normally like 3 to 5 days before we're actually closing.
Yeah.
It's just a quick phone call to HR. Hey, are they still working? Cool. That's what that was. And they said, well, no, she's not going to be working.
Yeah, even 3 to 5 days sounds far out, but sometimes if they don't answer, then you got to call again. Now we're 2 days out, and you call maybe the day of closing. find a little document. Yes, we talked to HR, Susan at HR at school. Nope. So don't change right before closing.
I've had that happen multiple times.
Pretty
over
sure
my
you had
20
an
years.
agent, we weren't the lender, but I'm pretty sure you had an agent that got to the closing table and the wife had been fired from her job and didn't tell anyone, including her husband. And they found out at the closing table and came and ripped you remember the story?
Yes.
Yeah, came and ripped the closing documents out of their hands and said, sorry, you can't buy this house. Kind of thing. I mean, that's super extreme and talk about heartbreaking, but she also didn't disclose that she no longer had a job. So and let me rephrase, we were not the lender in that transaction.
And that is lender fraud, guys, so.
The
Yeah,
most, there's the last little, it says must keep you in the loop every step of the way, use as a resource. We're all on the same team. So, there's no shady, there's no weirdness, like let's just all communicate, because if all of a sudden we, I think even Travis had one, like lady knew she had a collection that hit during the process. So you're kind of proactively were prepared to take care of it when they did the little refresh and, so it wasn't a big shock for everybody.
Yeah, I mean, it's a cheesy joke that we sometimes tell to people, to the right clients. We're like, we're your mortgage priest. Just confess it all. Like, let us get that info, because it's better that we know it and then we can deal with it, like, in the right way, kind of. So.
Yeah, they're the gatekeepers before it goes to underwriting. And so they'll know what underwriters need to know or not know. But your clients can't hide things from these two guys. We
Yeah.
don't want that ever
So they have
happening.
A lot of like credit hiccups that need to be fixed where they can be approved for a loan. Are you the guys that walk them through that whole process? as
Yeah,
well?
so anytime anyone applies with us, and if their credit's either not where it needs to be, or maybe it's just low, but still good enough, but we can improve it, like, we will give tips, right? And like how to fix that. Sometimes it's like just advice we have, like, hey, you need to address this, you need to address this. Oh, you have some medical collections, let me tell you how to fix that. Sometimes credit's just so rough, like, we're not credit repair companies, and we may refer them out. Now, if we know someone is just like got awful credit, right? We, we won't discourage them from applying because it's kind of illegal, but we may say, hey, we think you maybe need to address your credit, first, kind of thing. We want to help everybody, but we also don't want to be in the business of just repairing everyone's like, bad credit kind of thing. But yeah, will we give advice and help? For sure. And sometimes those are like the most grateful clients that actually put the work in, get their credit where they need to be, come back to us, we make them homeowners. We love those. So there's a balance of what we're trying to do here.
Is there a max as to how many times they can apply since they're working on like, whether it be credit or, debt or whatever?
Well, they want to be careful. So because, if they're having their credit pulled over and over again, it's going to, maybe mess up the credit plan kind of thing. The answer is no, but they just want to be conscious about what they're doing, kind of thing.
Would you have them wait, I guess? Like how would they?
Like
know
if you
that-
had a client that came to you, right, and said, hey, I really want to be a homeowner, but I know my score, and we're going to talk about scores in a bit. I know my score is in the 500s, right? Like, to me, that's us having more of a conversation than them just applying and, finding out that their score is in the 500s kind of thing. There's a way that they can get a copy of their credit report. And if it's one of your clients, like, they can get it free, like themselves, and go online and get it. We can look at it and still give them advice without them applying, kind of thing. Because without the credit, like, we just don't have a chance of getting what's done. And sometimes it's people have bad credit and want advice, but they're not making their car payment, or they're not making their credit cards. So, you got to make your payments, kind of thing. You're not doing that. That's step one, sure.
And that's kind of the conversation they want to have up front is to gauge, has this person been working really hard and needs a little help to get on the right path? Or is it someone who's ignored it all and now is like, oh, it'd be fun to buy, and
It
so,
happens.
yeah. And the people who haven't been making payments current for the last 6 months or year, we don't want to spend the money pulling credit. A, it's going to hurt the credit more, but B, they've got to do a lot of work before we can even have that conversation.
Yeah, it's a lot of, I say a lot. We put a lot of thought and prep into anyone who applies, right? Like, there's some behind the scenes stuff. Like, we want to give them 100% of our effort, kind of thing. But if, they're not even handling their basic responsibilities of making monthly payments, they're not ready for a, $100,000 house. Cool. Zoop.
So this is, anytime you hear the term PITI, we're trying to figure out what someone's, payment is, total payment obligation is going to be. You probably heard PITI, principal, interest, taxes, and insurance. This example, I just try to give you kind of a current life situation as far as kind of what to expect on a payment. So I just put a value at 400,000, loan amount of 388. That assumes like someone's putting the minimum 3% down on a conventional loan. Interest rate at 7%. This is kind of where they are these days on a conventional loan. And I use a tax rate of 3%. I notated 3% because, as y'all know, different communities have different HOAs. Some have no HOAs, some have MUDs and PIDs and PUDs, all those things that get factored in there, and some don't. And so it adds up quickly. And so just like Carlin was saying, hey, maybe meet those clients for their initial excitement. Hey, well, I saw this house, I want to go check it out. Cool. Let them get them connected with us, because some people are getting, I say some, quite a bit of people are getting the sticker shock these days of, hey, a $400,000 house with the expectation, because I saw on Zillow someone put 20% down and something else. Here's a realistic payment on a $400,000 house. And so, if all of a sudden, let us somewhat be the bad guys. Hey, congratulations, you're pre-approved. You can qualify for X amount of a house. Hey, we really love this home that y'all just went and saw. Hey, let me do a worksheet and send it to you. That way they go, oh my gosh, I can't afford $3,800. Okay, what can you afford? That way y'all not spending the next days and weekends that without being with your family and doing things, showing people homes that they may want, but they realistically, number one, maybe can't afford or do not want to afford, because it adds up pretty quick. So that's the little PITI little reference on there as far as what to expect total payment.
And a good safe rule, because sometimes your clients will ask you guys questions like, what's the payment on a $500,000 home? What's the payment on a $300,000 home? Or what kind of home can I get for $3,000 a month? The quick, easy rule of math is it's almost 1% of the purchase price if they're putting very little down right now. Like, so this payment's almost $4,000 all in on a $400,000 home with the minimum down. So, and that's, and again, like you said, property tax rates can really adjust that. The amount down can adjust that. The interest rate can adjust that. But that's a good, safe rule of thumb. If they're saying, I want to buy a $400,000 home, but I want my payment to be $202,000 a month, you can see really quickly that's not happening. 3% down conventional.
And it's always the 3%.
Well, that's the minimum.
Minimum, first time home buyer. And the FHA rate could be a little bit better, but still same.
So I have a question. I don't really understand. So whenever you go to a builder and they're offering a 4.99 and you and then if they were to use you guys, it's obviously more. Why is that? Like, is it because they haven't, like, the builder has the money to put towards that?
It's one of a couple reasons. One, they either have their own like Lennar lending company or whatever, right? And then they can take the loss on the lending company because they're going to make so much money on they're just offering incentives because they're just trying to get stuff sold, right? Or the second thing is they go out and buy a pool of money at a certain rate, like well beforehand, and then once that money's gone, that introductory interest rate is gone. So let's jump in the time machine about 16 months ago, when builders, I don't know if y'all were doing real estate at the time. I think a few of y'all were. It was wild. Builders were just number one, you had to like overbid on a new build because there's so many people. Multiple times we had people under contract for a new build, and the builder would call them like, hey, we just wanted to inform you, we're going to raise the purchase price $20,000 on your house that you've already signed paperwork for. If you don't like it, we're going to throw you off and sell it to the next person, kind of thing.
Is that legal?
Yeah, the builder contracts are written that they can do that.
Yeah, it was crazy. And the people were like, what can I do? Like, I love this home.
Oh, it was worse. If you upset the on-site salesperson, could terminate you on the contract.
Yeah.
Don't builders use furniture?
No,
It's,
no.
I always joke, if I won the lottery, right, I would spend some of my free time trying to like make the playing field even between builders and mortgage lending, because it is a little unfair, like what they do sometimes. Obviously, getting the client a 4.99 rate is fantastic. The client's going to love it, but it's not always gonna be like that. You know, just 16 months ago, it wasn't. They weren't offering any incentives, none at all. So we were doing a lot of builder loans and then it just switched. It just like, and that's how quick the market will change. And it will happen again. It won't be out there forever. But right now, it's real hard for any mortgage lender, us included, to compete with those new builds. That doesn't mean we won't offer advice. You know, a lot of y'all come to me and say, hey, will you look over this worksheet? Do you see something, you know, funny with it? And like, we're your teammates. Like, we're here to help, but can we match them right now? Probably not. But does that kind of answer your question, how they do
And
that?
they do have some of them have like the permanent low rates. Some of them are just the temporary buy downs that, you know, everyone can do even on resale house. And you'll be able to slide about that too. So I always try to, every time I see those little advertisements, I get them too. I'm always like, I try to find a little asterisk at the bottom to see, okay, is that a temporary buy down? Is that a, you know, what is it? But same, you know, it makes payment look a little bit better.
4.99 and then on the bottom it says, 5 point something.
That's probably the APR.
Yeah, what?
The APR is just a fancy formula that like rolls in the fees. So like if you were going to two different lenders and they were both offering 4.99, right? But say one person's APR was 5.25 and the other person's APR was 5.5. Well, that means lender number two had more fees. So the APR is just a way to like shop, like what's my true cost kind of thing. Your mortgage payment is based off the rate.
How come you guys don't pre-purchase a pool?
You got some money we can borrow? to
It
pre-purchase
takes
them?
millions.
Yeah.
It's million. Usually the builders, I just talked to a builder last week and they'll buy them like in 30 million lots. So
Oh, so
it's an
like an absurd amount
enormous,
of money they're buying.
it's an enormous amount of money.
It's like a pre-purchase commitment to.
Yeah, and
Would you do a participation loan to pre-purchase?
so I'll answer it this way. We will always be helpful to your new build clients when we're able to compete, right? Like absolutely, we will do deals for new build constructions. We personally have no interest in being a builder's preferred lender. We have lived that life. They don't treat you right. You're on call 24/7, it feels like. And it's just, and we're here for y'all. We're not here to be a builder's lender. Like we aligned ourselves, pun included, to, you know, be y'all's teammates kind of thing. So yes, we can help out with new builds. We don't want to, you know, we don't want that relationship right now.
Yeah.
I was thinking.
We have to, then you have to answer to them and they have their own ways. Yeah, I could tell you stories over, you know, a drink sometime of what that life is really like. Cool. What's next?
Yeah, good old, so term debt to income ratio, if y'all heard DTI at some point along the lines, or if we have to be the one that delivers, delicate, information to y'all to tell the buyer that, hey, I know you want that $500,000 house, but your debt to income, your income only supports X amount of a house. It's not overly fancy. It's either got to fit within the box or it doesn't. So debt to income, we factor in, okay, what is someone's gross income? So anytime someone's, if they're, hey, my take home is X pay. We'll just know take home is after all the deductions. We're going to use gross before all that is, factored in. We look at, okay, what is their future house payment plus their current monthly obligations? So whether that, be the minimum credit card payments, car loan payments, student loans, child support, anything like that that's required to be paid, not their normal side expenses. Basically, all that cannot exceed about 45%. 45 is a good number to give us a little bit of breathing room. There are technically loan programs that go up to 56 and 59.99. That's one reason why sometimes we go with a certain loan type. Some conventional is a little bit tighter. FHA or VA government loans give us a little bit more, flexibility. But sometimes that just so you don't need to be quoting someone their debt ratio and doing all this calculation because they probably didn't disclose every debt that they have, or they forgot about something. Just know that if we say they can't qualify because their income doesn't support it, their debt to income is too high, that's what it is. If they had that new lease payment, all of a sudden they got excited, they signed the lease because it was a great deal. They could upgrade their car in 3 years, whatever it is. Well, that $900, that may be $900 that gets taken away from that the house payment that they could have been that could have included the extra $900. And go back to your lease thing. Sometimes if you have an installment loan, you can pay it off early. Leases, you can't. So they're even worse than most installment
I
loans.
remember thinking, big car.
That, and that does happen. I had a lady who was shopping for a long time, very patient. And she was like, I think my car is not gonna make it. If I have to get you, and she was like, I do not need an expensive car. If it does, can I still get a $500 car payment throughout this process and qualify for it? Because she knew her budget. What, and the answer was yes. Hey, you can go buy it and you can afford a $500 payment, but let me know. That way we can get the new car payment, get it all factored in there. That way we don't catch it at the very end and start scrambling.
And if she couldn't, we probably would have advised to Uber for the next couple of weeks to, before we get that new car payment, if you want to buy the house. And like Tyler said, like, all y'all need to really know about this is like, this is when we come to y'all to say, hey, the debt ratio is too high, right? We're just shopping above their thing. But what we'll do with your clients is give them advice on how to shrink that debt ratio. There's tricks and tips that we have that we can do that, or what we can address. We're solely focused on the monthly payment, not necessarily the balance. So there's, some strategy there when we're looking to pay off debt. But just know that, like, we always give your clients a plan if their debt ratio is too high.
And I'm going to chime in on this. When you're working with a buyer and you know their debt to income ratios are tight, like the minute the lenders are saying, hey, we're tight on ratios, then that's an indication to you that we want to be focusing on neighborhoods that have lower property tax rate. So if they're like, oh, I'm looking at Sunfield and I'm looking at Six Creeks, well, we're going to Six Creeks because the rate's 0.5% lower, right? And then we also need to be shopping their homeowners insurance. And you're probably going to want to talk to somebody like Goosehead, who has access to carriers that can get the rates down. Allstate, State Farm, the top of the line companies sometimes have top of the line pricing. And if their debt to income ratio is tight, then they may need, it may need to not be 100 a month, may need to be 70 a month. And so just make sure they know, like, hey, I'm going to have you get a couple quotes on insurance because we need a less expensive option. And then once they close, they can always switch it to the more expensive option if they want. But to get it qualified under those ratios, sometimes we've got to get really creative.
Yeah, and a lot of times when we're working with clients, like, the debt ratio is tight, right? But we'll disclose that to you and the client. And, we like to build in a little bit of breathing room in case there's something that pops up while we're under contract. But if they want to roll with it, knowing that it's tight, like, if everyone's on the same page, then we're cool with it. So, but, we just want to make sure that we're setting them up for success and that we're all clear on where we're at with our approval. Just depends on the person, the profile, the loans, which we're about to jump into. I'll give you an example. I had one that I knew we couldn't go over 50% total debt ratio. We got approved at 49.7. I mean, we're talking fractions. But yeah, I mean, they were cool with it. Like, it wasn't a mystery, and like, they knew.
It's very black and white.
Yeah,
Like,
it's not rocket science for
No.
us, like, when it comes to debt ratio. Now, how we, structure it and like provide advice, that takes a little bit of skill, but the numbers are the numbers.
Should we be giving this advice to or like talking this to?
No.
our clients?
No. This is, yeah, we might have jumped in a little deeper than we needed to. The main thing for y'all is to understand, like, this is how we figure out how people get approved for their amount. And that when we speak to you and we say, hey, this property is pretty tight on our ratio, this is what we're talking about.
So the thing to understand is, like, they'll know their monthly income based on what they're getting paid, right? That number's not changing. They also know that these are the debts. We can't change these. They can't pay them off, right? They'll say, can you pay any of these off? No money, pay these off. Okay. So the only thing we have to mess with is the mortgage payment. And so that's where, the property taxes and the insurance and the HOA are all going to affect that. And so the minute, like, oh, we pick an HOA that's 100 a month versus 20 a month, that can kick your ratio over. And now we're at 50.01 and we're not
The
qualifying.
lower
The tax rate,
and the
all
tax
of, yep, that's the number that we can affect. So
Yeah.
just know if they're tight, then you'll be like, hey, Travis, they really love this home, but it's in Sunfield and the tax rate's 3.1. Is that going to fly? And he'll do the exact numbers and tell you real quick.
Yeah, sometimes that debt ratio comes up, like when we're shopping for condos too. They'll
Oh.
probably seen those huge HOA fees on condos, like Sometimes that might take us over the
I was
edge.
literally just gonna say, I was on that property tour last week and there's a condo development that's kind of across from Sunfield, Stonefield on the east side, those white farmhouse looking the deals.
Yes.
And so, price at 324. So let's say you have a buyer that's, hey, you're like 315 is about your max. Like, well, hey, we found this home at 324. Can we negotiate down 315? Well, that house has a $315 a month HOA. It's equivalent of buying a $390,000 house basically. And so that would be an example of like, hey, all of a sudden ding, ding, whoa, HOA seems high. Oh, taxes seem a little high. Yeah, I mean, those are all things that we got to consider. So, yeah, that was.
And in that case, like that HOA is including like common trash and common sewer and common water. So it helps the buyer's monthly payment overall because their utility costs are down. But the HOA has to be counted in their ratios, utilities don't. And so that's where it really can screw them off. It's very rare. Usually the lender's gonna, if there's a lender involved, the lender's gonna step in and protect that. But it can happen for sure, and it has, but very rare.
I was just shocked when I read the HOA for closed for
Yeah.
fees.
Yeah.
Because online, you see people complaining about fees, and going, well, I'm not gonna pay mine.
Oh,
So I read that and I was like, maybe I want to.
yeah.
Yeah, a quick example and then we'll move on. With one of your agents here, we were helping someone who became incapacitated and didn't have any family members. So they had to, they're basically going to like the state's care. So someone had to sell their house for them. Well, they hadn't paid their HOA in 3 years. It was like $15,000 overdue. I mean, that HOA didn't start any foreclosure process or trying to get the home after 3 years. They just kept tacking on, dues kind of thing.
And what happens is the minute you're late, well, now they can charge late fees, and then they can get attorneys involved in to charge attorney fees, and like it gets out of hand really fast.
I don't
Yeah.
think so. Real quick, this is super straightforward. When we're talking about loan to value ratio, it's your loan amount divided into your property value. So this example, a $300,000 loan amount, the house is $500,000, means you got a 60% loan to value. It means someone's putting down a pretty sizable down payment on this example. Go to the next slide. Loan to values really come to play when we're talking about loan types, which leads me into this. Oh, you skip one?
Yep. Go excited there.
Oh, yeah, that one, yeah. So, there are, a couple categories of different loans. We offer all of these. The first two are, we call like no down payment loan, a VA loan, those are only for vets only, right? A USDA loan, that is, a 0% down payment. We'll jump into that in just a minute. Other low down payment options are FHA and conventional. And then what we like to call secondary loans. We don't start with these, but sometimes that they are the solution for your clients. Asset-based bank statement, a couple other different types of loans that we'll talk about in just a second. Yep, so cool. So VA loans, comparing apples to apples, this is typically the best loan out on the market. There's a reason, right? Our vets have earned the right to use this type of loan. 0% down payment, it's huge for our vets. Minimum credit score is 580. You'll hear me probably say this a couple times. Just because the minimum is 580 doesn't necessarily mean that's where we want to be. If I ever see anyone in the 580 range, I try to give them advice to get to at least 620. Makes a world of difference getting to 620. But yes, we can do loans as low as 580. Debt to income ratios, we've already kind of discussed this. This can really sometimes go up to like almost 60% for our vets. Like the VA loans are pretty flexible on what they'll, approve. I have one right now that's at 56% that's closing on Friday. Big perk of the VA loans is no monthly mortgage insurance. Mortgage insurance, also referred to as PMI, right? The easiest way to describe that, it's an add-on to your monthly payment, which can affect our debt ratio. That we have none for the VA loans, so it's fantastic. There is an upfront fee that the VA will typically charge unless you're a disabled vet. It's my understanding this fee just kind of helps the VA program keep moving forward and whatnot. And that's basically it. So all you need to know is that VA loans are for our vets. if you have a vet who's looking for a condo, this goes for an FHA loan too. You know, that's something that you're gonna wanna work really closely with us on. VA loans and FHA loans, the condo needs to typically be approved by the government entity that we're doing it with. But other than that, pretty straightforward.
Which is really hard to find condos approved for
Majority
VA
of the
and
times, the
FHA.
condos are not approved with the VA and FHA,
Yeah.
but it's something that we can easily look up for you real quick. Again, this is another 0% down payment. We get this a lot that people call up and say, hey, I want the USDA loan, right? It's great. It's 0% down. When people apply with us, we're going to look at every single loan option for them and provide the best advice that we can. USDA loan is a graded loan because it's 0% down. The issues with USDA is that the approval is a lot tighter. It's a 43% max on the debt ratio, which when you start adding car payments and student loans and credit cards, we can get to that 43 pretty quickly. And they don't mess around on 43. They're not going to take 43.01, right? It's 43, that's it, and we're done. So a lot of times when we're working with these clients that may want USDA, we just don't have the debt ratio we need. But if they do have the debt ratio, then great, we'll look at it. The other major things with this one is that the property itself has to be zoned for USDA, right? You're not going to find any USDA properties in Austin, right? You can find them in the outskirts still, and definitely, you know, like even further south, like, you know, Gonzales and, you know, parts of Lockhart and those areas. Anyways, we can look that up for you, you know, on the map. And there also is income limits. USDA loans are not designed for people who make, you know, hundreds of thousands of dollars a year, right? They're just not for that. And they will look at every single penny that someone is making. Say you got your 18-year-old child who's got his first job at Whataburger, right? And he's not on the loan, but he's going to be living in the house. They're probably going to look at that income and just, you know, and they look for every penny kind of thing. So, but yeah, those are just the basic overviews of USDA. We don't do a lot of them, but for the right client, they're fantastic. Just depends on the county, right? Travis County is over 100,000 now. Some of the other counties are around like, you know, 80 to 90. It just truly depends on the county. But once someone applies, like if we see that they could be a USDA loan candidate, then we certainly, you know, go that route. We just keep an open mind for all products that are, you know, available.
If you Google USDA eligibility map, you can put in an address of a home to verify if it will work or not. There's little weird pockets around us. All of Butte and Kyle used to be USDA. When I sold homes, it was all zeroed. It was pretty amazing. But so there are still some areas. And if you're a listing agent and you're listing a home rule, you should always verify if it is, because that's a great avenue to advertise the home. It surprises me how many agents are not advertising their home can go USDA when it can.
I
So
was gonna ask you, like,
yeah.
would you say, because I always tell people like, hey, look in the listing, it'll tell
No,
you.
it's worth, MLS
Process?
agents are horrible at
I
that.
just didn't know how, yeah.
I'll
Cause me-
see things that say VA and I'm like, there's no way this one's going VA, you know, like it's terrible. Yeah, agents are.
That's the unrestricted area in Buda, is that what?
Not Buda. Buda can't do USDA anymore, but just east of there. So USDA is the U.S. Department of Agriculture. So they created loans to help bring growth to agricultural communities. That was the whole intention of the program.
So like my friend goats, on.
Not if it's Buda, there's no way.
Nag exempt, like a tax break.
You left something, she's not jurisdiction, not in county.
She's in a county, so she may be in ETJ. Yes. Yeah, but yeah, no, if it has the word Buda, it's definitely not USDA.
Okay, so
Yeah,
even though
yeah.
she.
So no, it's literally at certain locations. And so what happens is the census reports come in and then USDA says, oh, this area has too much income, too much population, and no longer needs our loan, and it moves out of that area and goes and is in other rural areas. So it's got to be pretty rural.
And my neighbor has a rooster that crows every morning at 5 a.m. But it just made me think about your friend with goats. Yeah, it's not Austin, so yeah, I don't know why. Yeah, you just real quick, you said like the income limits, sometimes it depends on the family size too. So a family of 4 has one income limit, family of 5 or more has a different income limit. So a lot of ins and outs. with
And
that.
you can add back childcare credit, can't you?
Take it.
Yes, the main other two loans are FHA and conventional, so you'll probably see the most of. FHA is still a, consider a, low down payment of 3.5%. This does not have to be, this is Federal Housing Administration, it's not first time home buyer. So sometimes even when you've got people who are maybe own a home, that they did their VA financing, they can't use it again for the next home, they're gonna keep as a rental or whatever. So that FHA, you can still use it even if you retain another home. And still just put 3.5% down. Credit score is 600, like Travis always mentioned. If someone's at 600 and we know they're gonna be shopping for a little while, we'll try to do a little tips to give them 620. It just makes it so much cleaner, better on rates, everything else. Debt ratio, they go up to 56.99. And so sometimes when we got these little weird things working backwards, hey, if you like this house, we have to pay out that one credit card to eliminate $50 payment to get you below 57%. It's another reason why sometimes, based on someone's income, if we're figuring out if we want to go FHA or conventional, sometimes that extra debt ratio just allows them the buying power to get what they want. Monthly mortgage insurance, like Travis mentioned, it's something that they've got to pay because they're not putting 20% down. It just got quite a bit cheaper, what was that? Less than a year ago, but so it's, to me now it's actually manageable. It's not it used to be kind of an absurd amount, like you were truly rewarded for having good credit to not go FHA. No, it's really not that bad. There is a funding fee of 1.75%. It does get rolled into the loan, so it's like putting 3.5% down, but technically half of that gets rolled back into the loan, but still keeps your cash flows nice and low. And then there's no purchase price limit, but technically the max you can finance in Travis County is $571,550, which is kind of a lot for just still putting down just 3.5%. And that Travis County is Travis, Hayes, Williamson, Caldwell. They all have the same limits. When you go down to New Braunfels, it goes down a little bit. But
Yeah, and again, keep in mind, like, this is not for y'all to have to remember all of these percentages. This is for y'all to have just like, if you have a conversation with a client and they start talking about these things that you remember, oh, FHA has a purchase price limit, right? I better double check that kind of thing. Or like, I think, did you mention that FHA's PMI stays on for the life of the loan kind of thing? Like, that's a big thing. So again, these percentages, we're just diving a little deep for y'all. This is not stuff you want to necessarily get bogged down, but just so y'all have information. So if the client brings it up, you've heard it before.
Two questions.
Yeah,
But
what-
I do have a client that I'm working with, but they have an FHA. So they're kind of stuck on the down payment part. They're not fully there yet. But they're asking me if there's a way around that. I told them no, that it just pretty much is like based on the price of the home for what you're putting down, correct?
I mean, yeah, the down payment is pretty straightforward, 3.5% of the purchase price.
Then they also had a question on if they could, since they got approved for FHA, they really want to do a USDA, and where we're looking at is approved. Could they wait to bring down that debt to income ratio and then apply for a USDA, or is that just, if you got an FHA, that was the only thing to hear?
So I hope maybe this will answer your question. Everything that we do when someone applies with us is really fluid, right? Like if we want to do this and tweak that so we can get them in a different loan type, we can. Like when they apply, and I tell clients this all the time, like sometimes we'll get this phone call, I'm like, I don't know how much to put in when I apply. I don't want to put too much and just get denied and you not work with me. It's not like that, right? If they put in a higher amount or whatever, like we're going to adjust things. So to answer your question, like if they truly want to try to work on going to a USDA loan, we can do that. But in my mind, as the loan officer, if they're struggling with down payment, I'm going to be asking them questions like, well, hey, do you have a family member that may be able to help you out? Or have you heard about down payment assistance programs yet that may be able to help you, do the down payment assistance? Path of least resistance, right? Like how can we get these people to address this down payment and then we make them homeowners? Working to get to a USDA loan, maybe like a lot more time, process kind of thing.
And there may be like income wise, they may not qualify for USDA. So the best thing to do is just have them talk to the lender, or all three of you talk to the lender and say, we really want to go a no down payment program instead of FHA. What are our options?
we do have 100% FHA, DPA loan with no income limits.
I was gonna ask, so it's two separate things, FHA, and then we can ask for a down payment assistance with that?
Yeah, FHA is like the vehicle, right? That's gonna get you to be a homeowner. Then we could sprinkle on a little down payment assistance or something like that kind of thing.
So would the loan officer not? Because the loan officer that we're working with, they didn't offer any of that. So should we
So,
just say
yeah,
that, or
the official answer is not all loan officers are built the same.
we-
And you're working with a builder loan officer. They may not have down payment assistance programs. There's a whole backstory with that. I could probably guarantee you that the builders don't want to deal with down payment assistance
Yeah.
programs.
Yeah.
I don't know.
We've
of any-
seen a lot of builders who would refuse buyers who needed down payment assistance. And which is,
It's-
to me, discrimination, and that's a whole different thing, but
And like their discounted low interest rate, it's tied to a standard FHA loan. It's not tied to one that has any type of down payment. So they can't offer this great low rate and still get you assistance for your down payment.
In my experience, and I know, this is not, I'm not trying to generalize all builder lenders or on-sites. If it requires a little bit of work or thought, they're not gonna, they're moving on to the next one. Like that's just at least my experience. Now, I'm not saying that there's not really talented loan officers out there that truly care, but I don't know if you're gonna always get that from a builder. 800 credit score, 20% down.
That was so specific, I love it. I meant.
I'm just joking.
USDA or
by the way.
USDA.
No, I mean, it's whatever works best for the client. I don't care.
Okay.
Now, being truthful, some loans are a little bit more complicated on our side, but that doesn't matter. We're here to serve the client. We are licensed loan officers. It's our legal responsibility to offer the best product. And it's just morally responsible to offer the best advice. I think. So. Cool.
Yes, the last loan is the conventional loans, like we've been kind of switching back and forth on. You can put as little as 3% down. If you're not a first-time home buyer, may require 5%. You can technically still go as low as 620 credit score. Because of there is still monthly mortgage insurance. We notate it varies based on amount down in credit score. Normally, when you have someone who doesn't have the best credit score, meaning kind of less than 680, when we're comparing FHA versus conventional, I think you need to memorize the percentages, but it was 0.55, which I said was kind of cheap. Someone who has 620 on a conventional loan, it may be 3 times that cost because it's not really designed for that credit type of borrower. And so those are things that we're trying to figure out what's the best product for your client. Debt to income ratio, we said different ratio ranges. 45 is kind of the comfort level. They technically go up to 49.99, but it's not for the borrower who has a 620 credit score, no extra money in the bank, maybe it's changed jobs multiple times. It's you've got to kind of have the super strong buyer, but it's sometimes we don't know until we put everything in there and run it through. Like Travis mentioned on FHA, you technically have mortgage insurance for the life of the loan. Conventional loans, it does have the ability to go away once you have 20% equity in the property. Some people don't realize that it takes a while sometimes to get there. So even when it sounds terrible when it's like you got mortgage insurance for life alone with FHA, sometimes if you're putting minimum down in conventional, it may take 9 years before it falls off anyways. And so sometimes it sounds bad when you say it out loud, but you may be refinancing pretty soon down the road anyways. There is no upfront funding fee. I mentioned on FHA, there's 3.5% down, 1.75, there's a fee that gets rolled in there. There's no such thing on a conventional loan. And the conforming loan limits are $726,200. So literally someone could buy about $756,000 house, I think, and put 3% down as a first-time home buyer and get that big of a loan, which is kind of crazy. It used to be in the fours, I think, a few years ago. So
that's what I was just thinking. It's like, dang, that used to be in the boards.
And I was gonna add something just real quick. Tyler, you kind of started touching on it. We talk a lot right now about rates being high, right? And refinance. I actually wanted to explain that. That basically means that someone comes to us later on after they've purchased the house to restructure their loan term, right? Whether it be for a lower rate or maybe going from an FHA to a conventional. Say when we bought the house, their credit was a little low. We needed that FHA to make them homeowners. but they've been in the house 3 years, 4 years, whatever, their credit's gone up, rates have gotten better, we can look to refinance them into a better product for them. So the mortgage is not forever, right? It's just the tool to acquire, your home. But we like to be your lender for life, and you're gonna be, your agent for your customers for, their lifetime. So like, we're always constantly gonna like reach out and say, oh, hey, Mrs. Smith, I know we closed you a year and a half ago. Rates are, 2% lower. Should we refinance? Who wouldn't want a cheaper payment kind of thing? So you just hear a lot of like that talk of that refinance. It's, it's a tool that we have to get you a cheaper payment when the time's right.
Now,
I think we have one more slide.
go like traditional or FHA with VA if they've trained the military. I don't know if that would be.
I guess technically you could. I think you have to serve 4 years to like get your VA benefits. But also like we would have to look at the financial part of that. So like the basic answer is, yeah, you could do that. Would it be beneficial? It may not be, right? Like depends on where rates are at that time. Like we mentioned, VA, sometimes has a funding fee. So we don't want to be, adding fees that we don't need to, but I mean, yeah, I guess you could, if it makes sense, kind of thing.
I don't know if it makes sense.
I never had that, right? Like typically if someone's a veteran, like 99% of the time, we're gonna use the VA loan. There are rare circumstances, but that's a great question. Yeah, no one's ever asked me that, so.
It's always nice to keep that VA benefits in your back pocket too, to use it for the next house. Because maybe they're buying their next home that's twice as expensive, but that they can buy it now without a down payment. So because they, so.
Yeah, and we got just a couple more. We'll kind of run through them real quick. We've already kind of covered them. This next slide was about down payment and closing cost assistance, right? You kind of mentioned, asking about that. The easiest thing to know is that there are programs out there for your clients to help them with down payment, right? Now, there are different guidelines and restrictions with each of these programs, but the main thing for y'all to know is that these opportunities exist. So if someone's talking about struggling with down payment or whatnot, hey, I know a lender that has down payment assistance options. Maybe you should just give them a call and talk to them about it. Depending on the program, there are some pros and cons to it. But if the challenge is truly down payment, then this is the solution and the answer sometimes. So it just helps people become more, homeowners. The one that's up there, T-Shack, Tyler and I have been using for many years. We're actually preferred lenders with them. Our names are on the website. We love that program. And then he mentioned earlier, we do have an FHA 100% financing. Not going to go into the details, but just again, know that there are options out there to help your clients with down payment.
Why do you like the one more?
It's not that I like one more. It's just that one was newer. T-Shack is probably the most common one in the state of Texas. It's real straightforward, good people, like never had any issues with them. I mean, they're easy to work with. Yeah.
So yeah, the only thing to add is that those T-Shack, there was a time, sometimes the amount of assistance they offer comes and goes. So some days they'll give up to 4 or 5%. And there was a time when the market was so volatile, they didn't post rates. There was no products out there. So it was a little like I remember leaving here to have a conversation with people that said like a week prior, you're pre-qualified going DPA. Then it's like, stop looking at houses right now. If you get under contract, I don't have a product for you. At least our other one, there's no volatility of available or not. Like you always can get 3.5% down. So it's kind of
yeah. There's a couple different options out there. Those are just the two we typically turn to get the job done. And I think that's our last slide. We mentioned that most of the clients that we work with fall in those 4 loan types we talked about: VA, USDA, FHA, conventional. But every once in a while, we run across someone who just doesn't fit in that box, right? So we call these our secondary, or the official term is called non-QM loans. QM stands for quality mortgage kind of thing. These, again, high level for y'all, but just to understand that these products exist, there's a bank statement loan. The reason this example is fantastic is a lot of times when we work with self-employed borrowers, they like, oh yeah, we made $200,000 last year. Well, we get their tax returns to verify it, and they wrote off so much money that their income that they told Uncle Sam isn't what they actually truly made, right? We're not the IRS, we're not the, the tax police. but we have to go off of, on a traditional route, we have to go off of their tax returns when they're self-employed. Well, if that's the situation, maybe we'll switch it to a bank statement loan. We literally go through 24 months of bank statements and look for their deposits that are business related. And it gives us a chance to maybe get a different higher income figure. Quick example, working with someone who, sent me their returns and like, they just did not have any money once it was all written off. Very creative accounting, I would call it. Did a bank statement loan, and now it's like, they own a construction company, but it's $30,000 in income a month that we have for them for the construction company. But with the tax returns, they couldn't get approved. Next thing, asset-based, same kind of, category. Basically, we take someone's overall assets and then can use that to produce an income figure. Just worked with one of your agents here that we did that. It was someone who retired, right? So they, on a fixed income, very low, but had $700,000 in like stocks or assets or whatnot. So we were able to use that asset to help supplement the income, make them a homeowner. And the final one is, this is fairly new. They're called DSCR loans. If you're dealing with investment clients, you may hear this. It's pretty straightforward. It's not really income based. It's if the payment of the mortgage covers what the monthly rent's going to be, that's what we're looking for, kind of thing. So again, don't need to be expert in these, but just understand that there are other loan types out there that, could help your clients. And we're certainly going to explore them, if we find a traditional one won't work. We don't necessarily turn to these right away. These are kind of why we call them secondary loans.
We're
But if
doing a
it's-
whole class on them.
Yeah, we're gonna have a little more deep dive into them. They're really fantastic. And, it's just another way to, hopefully make someone a homeowner that couldn't in the first chance.
I did sneak in one more slide.
Oh, you did? You spent one on me?
I did.
Oh, yeah. This is you.
So we were talking about, maybe it's something that gets advertised for like a super low rate that maybe doesn't look quite right. If someone is paying for a mortgage buy down, a buy down is when you get basically a temporary relief on your interest rate, and it's something that is seller paid, so it's got to be negotiated for. And there's 3-2-1s, 2-1s, or 1 year buy downs. 3-2-1 means the year 1 you get 3% off the rate, year 2 you get 2% off, and then year 3 1% off, and then it goes back to your normal mortgage. It's not an adjustable rate mortgage or anything like that. It's just basically a seller paid kind of relief. And so I just did it just to show you what it takes, like we were, joking about, like they may new construction stuff, and maybe it is a good low rate, or maybe it's just a little temporary program. They may be doing something just like this. And so you can see on a $400,000 loan, if they did that year 3 of getting a discount of 3% off the rate, that's $751 a month. It's $9,000 that has to be negotiated just for that year 1. So you can see year 2 a little cheaper, and then 3, so $18,341. That's a lot, and it has to be negotiated to be paid by the seller. I've got a deal closing on Thursday to where it's higher price point. They weren't comfortable. They have future goals of getting, a raise, changing jobs, things like that, but they were not comfortable buying the home that they're buying unless they had a temporary buy down. Their buy down cost almost $24,000 to do this, but the agent put, hey, we'll give you X amount for the offer, but we need 30,000 in credits, and we use 30,000 credits to, for their temporary buy down, and pay a little bit extra of their closing costs. The great thing about this is that that money is just set basically in a forced savings account to kind of supplement this payment. And so if in a year rates do get better and we refinance, or in 2 years, whatever money is left over, this gets refunded back to them. So it's not money lost, but it's a great tool, versus them negotiating $24,000 off the price of the home, which may save them, $180, $200 a month. They have something that they negotiated, like an extra forced savings account is going to save them, $751 the first year and $513 the next year. And for them, that was what justified making sense, knowing that their future goals, to get the payment they wanted right out of the gates. So just more of if you got a specific scenario, we can see the little calculators just to know that when you see temporary, a little asterisk we've joked about that at the bottom of a flyer for a temporary buy down, just know that's what's going on. So
and to switch it to y'all, like, for y'all's real life examples, like we're seeing a lot of this, like they said. So, for your buyers, hey, if they're talking about high rates, and, they're focused on resales, hey, there are options out there to give us a temporary reduction in payment. For your listings, on resales, we're seeing a lot of this being advertised too, because they're just trying to get more, more eyes on it. If you ever need us to run the numbers, let us know. But this is a really awesome thing. This is like less than a year old, I think, that has been out there.
It's a great marketing tool for you guys to promote to buyers. Like, hey, if you think you're waiting till rates come down to buy, let me tell you why that's a terrible idea. And this product can really help you get the rate you want for the next 3 years until, there's a chance to refinance. And buyers totally say they'll take advantage of this if they knew it existed. But the problem is nobody even knows this is an option. So we really need to get the education out there.
And I know Tyler mentioned it. This is just like on the 3-year example. I'd say the most popular one we see is the 2-1 buy down. So, reduction for, 2 years, but whatever the seller is willing to give up, we'll use it, we'll take it for sure.
I think most listings I see, it's 10,000 for, buyers, temporary buy down. Like Travis said, if you eliminated that $9,000, then it's the 6,167 plus the 3,000. So it's just shy of $10,000 is what's needed for someone to do the 2-1 buy down. So 10,000 seems to be like the number. The one that would go close on Thursday, they needed 24,000 and they negotiated, price of the home. So.
This market on resales, buyers, sellers are pretty motivated. So you should be able to get in and negotiate something for sure.
Cool. So I know that's the last slide.
Well, I'll think about it.
Come on. Real quick. So just after you make your referral to us, what happens is we try, to at least get in contact with them immediately, but definitely no longer than 24 hours. Always like to kind of start with a phone call. At least I do. If someone wants to jump into applying right away, that's cool too. But always want to know about the goals. I want to get to know the client. Like, we live here, we work here. I get generally interested in the people that I work with and what they do. So want to get to know them a little bit, answer their questions, and talk about the process. Then we're going to start them on that pre-approval route, right? This lets us try to address anything that may need to be addressed, or at least give them better financial advice and tools on what we're looking for a mortgage. We're going to review the app, their financial documents, ask all the pertinent questions. When you are trying to get someone pre-approved, like if it's we got to move someone, like trying to go, like we can do it pretty quickly if it's straightforward. If it's super complicated, we may need a little bit more time. For the most part, we'll get you an answer really quickly. And then, we want to get them back into you. Like we've mentioned many times, we're a team. So we want to, I love it when they, say, hey, can I include Iris on the communication of what we're doing? Well, sure. So I'd like to keep you informed the whole way along of where we're at the process. And let's go make some offers and make some homeowners. So, and I don't think we, we should have started with this, but, my name's Travis. I live here locally in South Austin with my family and dog. I'm a big fan of, our Austin scene, whether it's live music or I'm a volunteer for the Special Olympics. So I just love living in Austin and I love helping people become homeowners.
Yeah. Live here in Dripping Springs, got 3 kiddos. So Travis and I joke, we don't work bank hours. But if you call us after 5 o'clock or you call us on the weekends, you're probably gonna hear a kiddo in the background. I'm not gonna hide in the closet. But we're here to help you out. Travis and I have been working together. We've kind of moved together to a couple different places, but we've been working together for over 10 years now, which is kind of crazy when you zoom back out. But yeah, we're here local. Want to help you out.
Yeah, just reiterate, holler anytime, right? Like obviously we have a life and sometimes we may be busy, but don't, send us a text, give us a call. We'll get back to you as soon as we can. Like, people want what they want when they want it, right? So we need to be pretty, responsive on helping out our clients. We're here for you.
You left out your shrimp.
Oh, yes. And I have my kids, we have a 10-gallon tank and we have 6 shrimp and
Shrimp fry.
yeah.
Thanks, guys. Let you guys go. Thank you.
Thank y'all.
Thank you.